Today, the economic whipsaw. The DFA Daily to the 2nd of August 2021. Hello again, it's Martin North from Digital Finance Analytics World, with this post covering finance and property news with a distinctively Australian flavour. In today's show, we discuss who is bearing the real costs of the lockdowns, the problems of wages growth, the trajectory of home prices, mortgage underwriting through the lockdowns plus branch closures, New Zealand property listings, and finally, the latest actions against AMP. And first, as Alan Kohler wrote in the New Daily, the plan is to go for a vaccine target of 80% of adults, which is actually less than 60% of the population and not enough to safely open up. And frankly, even that take-up is out of the government's hands now. So the only thing Scott Morrison has any control over is financial support for those affected by state lockdowns. But Friday's removal of the phrase "no lockdowns" to be replaced by predictions of more lockdowns was unaccompanied by a plan for providing that. Lockdowns are by far the most expensive way to control a pandemic, especially when compared to the $4 a dose for the AstraZeneca or even the $40 per dose for the cost of Pfizer. Last year's lockdowns were only briefly painful for the economy because of the JobKeeper program at a cost of around $93 billion. It was both great policy and a debacle. It saved the economy because of its speed and generosity and saved hundreds of thousands of people and businesses from going under, but too much of the money was stolen from under the government's noses. Almost every day, a new story reveals more details about how the scheme was mismanaged and rorted. If any scandal ever deserved a Royal Commission, it's this. The money for JobKeeper was provided by the Australian Office of Financial Management, or AOFM, and they auctioned bonds roughly twice a week, for a total of $160 billion. The cash was deposited in the government's cheque account with the Reserve Bank as it was raised. A bit more than $30 billion of that went towards funding the government's normal deficit operations last year and paying for vaccines, and $30 billion is still at the bank unspent. But most of it went on JobKeeper. And separately, the Reserve Bank has bought about $160 billion worth of government bonds over the same period using money it credited. That's a coincidence. Governments sell $160 billion in bonds, the RBA buys $160 billion in bonds. It looks like monetary theory in practice, that is, printing money to fund the government, but it's not really. The RBA is doing it to hold down interest rates, not to give the government money. But it does mean the AOFM pays lower interest rates than it would have done, and that raising the money from the markets is no problem at all, because the buyers all know that they can unload them to the RBA for a quick profit. At the moment, the AOFM is only selling around $700 million worth of bonds every couple of days instead of $2 billion per auction as it was doing last year, because this year's lockdowns are costing the government a lot less. And that, of course, is because JobKeeper ended and this year's programs are tighter and more miserly. Treasurer Josh Frydenberg might be happy about that and proudly telling his federal cabinet colleagues that the lockdowns are costing less this year and the deficit and debt is under control, but they should all be careful what they wish for. A lockdown costs what it costs. The amount is immutable. The question is, who bears it? If the federal government is no longer bearing all the cost, someone else is, and they won't forget. And also the economy generally will be harder hit. With the RBA buying bonds at the rate of $4 billion a week and the 10-year government bond rate at 1.19%, there is absolutely no excuse for the government not to bear the entire cost of lockdowns. That it's refusing to do that should be the lasting memory of Australia's pandemic and should result in the coalition's defeat at the next election. That it pointlessly allowed a few families to be financially ruined by lockdowns in 2021 that were caused by its own failure to order enough vaccines when it could easily have borrowed the money to save them is unforgivable. And of course, the other big question is wages growth, or the lack of it. And according to Peter Martin, writing in The Conversation, Australia's top economists have overwhelmingly rejected cuts to either permanent or temporary migration as a means of restoring lost wages growth. None of those surveyed were optimistic about the prospect of quickly lifting wages growth, by the way. And the Reserve Bank said in July it wasn't planning to lift interest rates until aggregate wages growth exceeded 3%. The 56 leading economists polled by the Economic Society and The Conversation include a former head of the Fair Pay Commission and a former expert member of the Fair Work Commission's minimum wage panel. Among the experts selected by their peers are specialists in economic modelling and the economics of labour markets from both the private and the public sectors. All but 5 rejected cuts in temporary migration as a means of boosting wage growth. All but 3 rejected cuts in permanent migration. The results put the economists at odds with Reserve Bank Governor Philip Lowe, who last month drew a link between temporary migration and weak wage growth, saying employers had been using overseas hires to fill gaps that would have been filled by locals, diluting upward pressure on wages in these hotspots. And he said this might have spilled over to the rest of the labour market. Cutting temporary and cutting permanent migration were the first 2 of 10 options for boosting wage growth presented to the panel of economists. The panel rated them third last and second last. Only holding back growth in female and older worker participation was marked down more. Each economist was asked to pick 3 of the 10 options. The most popular, picked by 78.2%, was measures to boost productivity growth. The next most popular, picked by 50.9%, was measures to boost business investment. Michael Keane of the University of New South Wales said the idea that population growth and increased labour supply were constraining wage growth was so naive as to not really be worthy of comment. Consultant Rana Roy said only a cultivated amnesia could ignore the near uninterrupted growth in real wages in the US, industrialised Europe and Australia amid record inbound immigration in the decades after the Second World War. Gabrielle de Souza of the Committee for Economic Development of Australia said the idea owed much to a one-dimensional view of the world that saw only the direct impact of immigrants on particular wages and not the impact of their demand for goods and services on a broader range of wages. Dozens of studies had identified the overall impact as near zero. Robert Brewing of the Australian National University said immigrants appeared to add to productivity rather than detract from it, meaning slowing down immigration could slow down rather than add to productivity and growth. 3/4 of the panel nominated productivity growth as the most important precondition for higher wages growth, endorsing the conclusion of Nobel Prize-winning economist Paul Krugman that productivity isn't everything, but in the long run it is almost everything. Krugman famously added that a country's ability to improve its standard of living over time depended almost entirely on its ability to raise its output per worker. Ian Harper, a former head of the Howard government's Fair Pay Commission and a current member of the Reserve Bank Board, said that without productivity growth, any boost in wages growth that was delivered was likely to be nominal, matched by inflation rather than real, delivering higher living standards. One of the best tools for lifting production per worker was business investment. And 1 in 5 economists who thought immigration hurt wages growth, Macquarie University's Geoffrey Kingston, said it seemed to do it by thinning investment per worker. In the 1980s, under Prime Minister Bob Hawke, increased immigration helped push down real wages for 5 years in a row. Several of those surveys said wage growth needed investment in more than machines. Griffith University's Fabrizio Cremani said also mattered was investment in human capital via education and research and development. Now, elsewhere, according to Australian broker, New South Wales property prices might get a boost from the ongoing Sydney lockdown, according to a leading property expert. Lloyd Edge, director at Oz Property Professionals, said that the main source of demand would be investors who were more willing to put their cash in without viewing a property first. Property prices are going to keep moving forward and investors are going to start coming into the market more, said Edge. It's probably going to put a bit of a dampener on home buyers who have been driving the market most of the year, but now investors are going to start coming in. A lot of those are going to be people buying property sight unseen. The principal cause of the demand, however, will be the lack of supply caused by prospective sellers taking their properties off the market in anticipation of higher prices down the line. There's going to be less stock, said Edge. Part of that is vendors taking their property off the market and hoping to relist them after the lockdown, while other vendors are not listing because of the lockdown. There's been a couple of examples where they have been listed and then taken back off. That lack of stock is going to put upward pressure on prices because there's still a lot of buyer demand around. Now, it's hard for home buyers to get out and inspect property, so you see investors coming back into the market. In my world, as a buyer's agent, there's still plenty of inquiries and people coming forward to do things. I'm not seeing any real signs of it slowing down. In particular, the end of lockdown combined with the traditional spring listing season could see prices pushed up yet further. For August, and for however long the lockdown goes on for, there's not going to be an immediate growth. There's going to be investors, but as soon as more properties get listed, we'll see home buyers coming back, explained Lloyd Edge. Springtime is usually a good time for listing things anyway, and if we do come out of lockdown within the next month or 6 weeks, who knows how long it will actually be, then I think there's going to be more properties and they'll be listed for more than they would have been before. Well, we'll see. I think the story could be rather different from that. Now, on the other hand, Westpac has reduced the operating hours of 198 branches in Greater Sydney after the government of New South Wales extended the region's lockdown until the end of August due to the rising COVID-19 cases. Affected branches will operate now from 9:30 to 2:30 starting on Tuesday, according to the AFR. Ross Miller, the Chief Engagement Officer at Westpac, told the AFR that the bank reduced branch hours to give our employees the opportunity to better juggle home and workloads during this unusual time. We have seen reduced foot traffic in our branch network during lockdown as more people stay home, and would encourage customers with non-essential banking needs to use our mobile, online and telephone banking services where possible, said Miller. And the AFR said that the move was supported by the Finance Sector Union. The National Secretary at the FSU told the AFR that the bank had also suspended performance goals for branch staff. The FSU has been asking all banks to stop insisting staff meet sales target during the pandemic, they said. We are calling on all banks to follow Westpac's lead and suspend sales targets and allow workers to get home as soon as they can, rather than remaining in workplaces unnecessarily. And mortgages might be harder to get as lenders tighten mortgage scrutiny due to the lockdowns, the MPA says. Property buyers could find that qualifying for a mortgage is harder this week as major lenders tighten the screws in response to concerns about the impact of COVID-19 lockdowns. Commonwealth Bank, the nation's largest lender, said it would announce temporary changes to policies as a result of the current coronavirus situation that involved heightened scrutiny of any loss or reduction in mortgage applicants' income, according to the AFR. Other lenders, including non-bank Resimac, are asking New South Wales borrowers mandatory questions about how the pandemic is affecting their income. Other lenders will likely follow with their own stricter criteria as concerns rise about the uncertainty caused by the lockdowns and amid increased pressure from regulators to lend responsibly. The heightened scrutiny comes even as record low interest rates and booming demand are expected to boost Sydney's property prices by more than 21% this year. Melbourne prices are predicted to rise by 18% and Hobart prices are expected to see a 23% hike, according to analysis by National Australia Bank. Resimac Group Chief Executive Scott McWilliam told the AFR that the company is heightening scrutiny to ensure it is not relying on documentation that may not reflect the current borrower's situation. This means a heightened level of due diligence on income-related supporting documents, McWilliam said, and he said that the non-bank has not made any changes to products or policies about such things as loan-to-value ratios. CBA, which previously said it would use only the latest income documents for loan applications, is also expected to tighten standards. And CBA also said it would not accept JobKeeper payments as qualifying income for a mortgage application. Lenders are already asking additional questions about how borrowers are likely to be affected, especially those from Sydney. Anita Marshall, the Managing Director of mortgage broker Advanced Financial Solutions, told the AFR, and Matt Florence of estate agency Upside Reality also told the AFR that lenders were increasing their scrutiny. Resimac is telling brokers to ask New South Wales loan applicants whether they have been affected by the lockdown and about its impact on their income. And Resimac is also telling the brokers to get borrowers to provide evidence for that impact, such as a payslip for the most recent pay period. If there is no impact, an outline of how the applicant has not been impacted still needs to be included, Resimac said in a memo to its brokers. Now, over in New Zealand, new property listings continue at a pace significantly higher than where they were in the pre-COVID era. Compared to July 2019, new listings this July were up 6.6% nationally and up 28.7% in Auckland. On the other hand, compared to July last year, new listings were substantially lower, with a decline of 11.3% nationally, with all regions recording a decline in new listings compared to a year ago, apart from Gisborne, where the numbers were unchanged. Overall, the number of people deciding to put their homes on the market appears to be flatter in July, according to results from property website realestate.co.nz, who listed 7,812 new residential listings in July, up just 0.6% compared to June. And around the country, new listings in July were up compared to June in 8 regions, including Auckland, Waikato, the Bay of Plenty, Central North Island, Nelson, Canterbury and Otago, and down 11 including Northland, Coromandel, Gisborne, Hawke's Bay, Taranaki, Wellington, Marlborough, West Coast, Central Otago and Southland. Price expectations remain firm, with average asking prices increasing in all main centres, pushing the national average asking price up to a new record of $870,295 New Zealand dollars in July from $861,411 in June. However, while price expectations were firmer in the main centres, they were weaker in the provinces, with July's average asking price down compared to June in places such as Coromandel, Gisborne, Taranaki, West Coast, Nelson and Marlborough. And finally, back here in Australia, ASIC has commenced a civil lawsuit against 6 AMP companies alleging they charge fee for no service on corporate superannuation accounts. AMP Superannuation, AMP Financial Planning Proprietary, AMP Services, Charter Financial Planning, Hill Ross Financial Services and AMP Life Limited, which is now part of the Resolution Life Group but sat under AMP during the alleged misconduct, have been targeted by ASIC in the new court action. The regulator has alleged the AMP companies charged advice fees for more than 15,000 customers, despite being notified that those customers were no longer able to access the relevant advice. AMP received more than $600,000 in advice fees from affected accounts, according to ASIC. The regulator has further alleged that from July 2015 to April 2019, the AMP companies deducted financial advice fees from 1,540 customer superannuation accounts, despite being aware that the customer had left their employer, sponsored superannuation account, and therefore could not access the advice for which the fees were paid. And they failed to ensure that a system was in place that did not charge customers who had left their employer-sponsored account and contravened their obligations as Australian financial services licensees to act efficiently, honestly and fairly. ASIC has sought declarations, pecuniary penalties and adverse publicity orders to be made by the Federal Court. The proceedings will be listed for a case management hearing with a date yet to be set. AMP recently dodged criminal action over the fees for no service saga after ASIC recently decided to drop an investigation into alleged criminal conduct by AMP Financial Planning. And the regulator decided to go no further after looking into suspected misconduct where AMP Financial Planning allegedly charged fee for no service in relation to its buyers of last resort policy. The new court action has followed another lawsuit commenced by ASIC against 5 AMP companies for charging life insurance premiums and advice fees to more than 2,000 dead customers despite being notified of their deaths. AMP Superannuation, AMP Life, AMP Financial Planning Proprietary and AMP Services are also subject to the proceedings, alongside NM Superannuation Proprietary. AMP Superannuation is the trustee of two super funds, the AMP Superannuation Savings Trust and the AMP Retirement Trust. And ASIC said that it will continue to prioritise enforcement investigations and remediation for consumers arising out of fee-for-no-service conduct. As at the end of last year, Australia's largest banking and financial service institution had coughed up or offered to pay $1.04 billion in compensation as a result of the issue. AMP in particular has paid out more than $153.7 million to more than 200,000 customers at the end of December 2020. Throughout 2019, the group conducted a full remediation program covering all affected superannuation accounts, in which more than $900,000 was repaid to affected customers for wrongfully charging advice fees to more than 2,500 superannuation accounts. So amid all the turmoil, all the ups and downs, life sort of goes on, but there are significant uncertainties in train at the moment. And the most interesting of all those conversations today was the one from Alan Kohler, which does suggest that we should be seeing more from the federal government in terms of support for those businesses and households who are now under pressure because of the lockdowns. I would certainly support that. But of course, we are still fighting ideology, and ideology is still based on less debt is good. So we'll see how that plays out. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.